Regulatory requirement of risk. Firstly, the meaning of financial stability. What is financial stability? Financial stability refers to a condition where the financial system, including banks, financial markets, and payment systems, are operated efficiently and capable of withstanding economic shocks. Banks are central to financial stability due to their role in credit, intermediation, deposit taking, and payment system. Next, regulation is necessary to prevent system risk, which is individual bank failures can cause ripple effects, leading to wider financial crisis. The second one is protect depositors. They ensuring banks have enough capital and liquidity safeguards depositors' funds. The third one is promote market disciplines. The rules and the supervision encourage sound risk management. And the last but not least, maintain public confidence. Regulatory oversight reassures the public that banks operate safely and responsibly. What is the financial structure of banks? Banks typically have the following financial structure, which is have three: assets, liabilities, and equity. Assets include of loans, investment, and reserve. For liabilities, they have customer deposits and also borrowings. The last one is equity, which is equal capital. Shareholder funds retain earnings, which acts as a buffer against losses. What is the effects of losses from risk events? Risk events, for example, credit defaults, market crashes, operation failures, and can have significant impacts, which is capital erosion. The losses reduce a bank capital base, weakening its ability to absorb future shocks. The second one is liquidity strain. Risk events can lead to sudden withdrawal funding challenges. Last but not least is reputation damage. Trust in the bank can erode, leading to a loss of business.
Assalamualaikum warahmatullahi wabarakatuh, and hi Madam Zawati. My name is Hazman bin Muhammad Johairi Nain. My metric number 01DKB 23F1037. Okay, for my part, I'm gonna to talking about the objective of the Basel regulatory framework. Okay, what is the objective? The main objective of the Basel regulatory framework are to strengthen the regulation, supervision, and risk management of banks, aiming to create a more resilient banking system capable of withstanding financial shocks and promoting global financial stability. Okay, the next is about the requirement of base 1. There are three base 1. Okay, firstly, minimum capital requirements. It means like banks must hold a minimum level of capital against their assets, weighted by a risk. The secondly is risk weighting. It means like assets are categorized by risk. For example, how I can say like government bonds with corporate loans. Okay, which higher risk asset requiring more capital. And lastly, capital ratio. Capital ratio means like bank must maintain a capital ratio. For example, tier 1 and tier 2 capital of at least 80% of risk-weighted assets. Okay, so it's me again. Okay, for this part, I'm gonna to continue. For requirement of base 2. Okay, there are three pillars. Pillar 1 is minimum capital requirements. It means like banks must maintain capital of cover credit, market, and operational risk. The minimum capital adequacy requirements is 8% of risk-weighted assets. And the pillar 2 is supervisory review. It means like regulatory assess banks' internal capital adequacy and risk management process. And lastly, pillar 3, market discipline. It means banks must disclose information to promote transparency and market discipline. And the next is requirement base 3. Okay, the first is exchange capital requirements. How can I say, like higher quantity and quantity of capital, especially tier 1 capital. And the second is leverage ratio. Leverage ratio is mean like introduction of a non-risk based leverage ratio to limit assets borrowing. And the last but not least, liquidity requirements. Liquidity coverage ratio LCR and net stable funding ratio NSFR to ensure banks can withstand short-term and long-term liquidity shocks. Okay, this is last my part. I'm gonna to explain for the requirements of base 4. Okay, first, reduce RWA volatility. It means like limits variability in the calculation of risk-weighted assets, or we call it RWA. And the second is exchange risk sensitivity. It means more granular risk weight calculation for complex risk profile. And the third is restrict use of the internal model. It means like limits bank use of internal model for certain exposures to ensure consistency. And the lastly, output floor. It means like establishes a minimum threshold for RWA calculated by internal models, setting the base for risk evolution. Okay, as you guys can see, the key Basel frameworks table at the below, they are summary for base 1 until base 4. Okay, that's all from me. Thank you very much.
Muhammad Asrafi Asmadi, and my metric number is 10DKP23F1003. So, today I want to talk about how the capital adequacy rules apply to Islamic bank. So, the capital adequacy rule for the Islamic bank are designed to ensure they have enough capital reserve to absorb the loss and remain the financial stability, just like the conventional bank, but with the additional consideration with the Sharia compliant activity. So the key aspect of the capital adequacy in Islamic bank, we have the regulatory framework, we have the capital ratio and risk-weighted asset. The purpose is to ensure the Islamic bank can absorb the stock from the financial stress, continue the operation in the compliance with the Sharia principle, and protect depositor and maintain the trust in Islamic banking system. So I will continue to explain the key aspect the capital adequacy in Islamic bank. The first is regulatory framework, which is Islamic bank in Malaysia follow the capital adequacy framework for the Islamic bank, and that's developed by the Bank Negara Malaysia (BNM), and is alike with Basel III, but the customized to reflect the unique risk and the characteristic of the Islamic banking contract. And the second, we have the capital adequacy ratio, which is the Islamic bank must to maintain a minimum total CAR 8% of the risk-weighted asset. The height ratio may be required depend on the bank size and the risk profile. So the last one is the risk-weighted asset, which is to calculate CAR, Islamic bank must to assess the risk-weighted asset, which is include the credit risk from the Sharia compliance contract like the murabahah, musyarakah, ijarah and mudarabah. So, and the last one is market risk from the expose the change of the in market price of the Sharia compliant investment like the sukuk and commodity murabahah. So that's all about the key aspect capital adequacy in Islamic bank. So thank you. So I will continue this video with the explanation about the nature of the exposure requirement bank nation. So the last exposure risk requirement is the regulatory framework established by the Bank Negara Malaysia or the BNM to control the credit risk around the banks lend a significant amount of the money to a single counterparty or the group related of the counterparty. So the aim is to prevent the excessive considerations of the risk of the return to the bank stability and the financial system. So the key features of the requirement is definition of the large exposure. So the large exposure is defined as any exposure that is the equal to or exceed 10% of the bank total capital base. And second, we have the exposure limit, which is bank in Malaysia must not have the exposure the single counterparty or the groups of the connect the counterparty exists 25% to their total capital base. And lastly is the connect counterparty. It's all exposure to entire that's the economical and the financial like threatens as one group to avoid the risk underestimations. So that's all about the large exposure risk requirement Bank Malaysia. So that's all. So in this part, I want to talk about the saving account and the investment account. So for the saving account, is the deposit account offered by the bank or the unions that allow you to store your money securely while they earning a small amount of the interest. So how does the operate? So you can deposit the money into your account and anywhere and anytime. Then bank will pay your interest rate like the monthly or the annually, and you can withdraw and transfer funds and anywhere and anytime. And every bank have the limit for the withdraw, which is have the 5,000 per month or the 500 per day. So for the investment account is used for the purchase the financial asset like the stock, bond and the mutual funds to grow your money over time. So how does the operate? So you can open the account through the brokerage or the investment platforms, and you can deposit your fund to buy the investments. So investment will grow based on the market performance. And lastly, you can buy and sell the asset anytime, but you may face the fee or the tax to gains. So that's all about the saving account and the investment account. So
hi and Assalamualaikum. So I am Muhammad Syahrir Zikri and my matric number is 01DKB23F1011. So today I want to talk about corporate governance. So describe the nature of corporate governance and its relevance to financial service in Malaysia. First thing first, what is corporate governance? So basically, corporate governance refers to the system of rules, practice and processes used to direct and control a company. And it's important because it ensures that a company is governed in a responsible, fair and transparent manner, especially in its dealing with key stakeholders such as shareholders, management, customer and regulator. So, what is the important in financial Malaysia sector? Especially in the financial service sector, corporate governance play a very critical role. The first one is it helps maintain investor to confidence in the integrity and stability of financial institutions. And then it ensures compliance with regulations set by Bank Negara Malaysia and the Securities Commission. Without good governance, companies are vulnerable to corporate scandal, fraud or mismanagement, as seen in the case of 1MDB. Lastly, strong governance contributes to sustainable economic growth and support the stability of the national financial system. So, in this slide, I will explain about code on corporate governance. So, the first one, basically, Malaysia Code Corporate Governance is updated regularly, latest in 2021. it set out best practice for company listed on Bursa Malaysia. So the first one is, it is based on the apply or explain an alternative principle. So the key focus areas is board, leadership and effectiveness, and effective audit and risk management, integrity in corporate reporting, stakeholder engagement, and encourage diversities about gender, skill, independence of director, and transparent remuneration of policies. So basically it maintain our investor to be confident and ensure compliance with Bank Negara Malaysia, which is BNM, and Securities Commission Malaysia. So add-on prevents to corporate scandals and mismanagement. So for example is 1MDB standard. And last but not least, to support financial stability and promote sustainable economic growth. So in my last slide, I will explain or identify principle of corporate governance. So the first one is accountability. Accountability is clear roles and responsibility at all levels of management. So the next one is transparency. So basically the transparency is about open disclosure of material information and company performance. And the third one is integrity. Integrity, the meaning of integrity is ethical conduct and compliance with laws. So the next one is fairness, equitability treatment of all shareholders, including minority interests. So the last one is responsibility. Responsibility of the corporate, social, and sustainable business practice.